Let's move on and look at the last learning objective for today's workshop, which relates to the periodic inventory system. So this is where a retailer determines its cost of goods sold at the very end of the financial period. And this relates to businesses that traditionally conducted stock takes. And as I mentioned earlier in today's workshop, the reason why a business conducts a stock take is so they can check what actual inventory they have on hand and therefore calculate what the cost of goods sold is for that inventory. Because remember, with the periodic system, they determine the cost of goods sold at the very end of the financial period. With the perpetual system that we have been looking at in today's workshop, a business determines its cost of goods sold at the time that transaction occurs, so at the time they sell inventory. So now let's have a look at a periodic inventory system and how to account for it. Okay, so as I mentioned, when a business using the periodic system sells inventory, they do not update the inventory account and they do not make a recording for cost of goods sold. They only record purchases that they make during the period, the associated costs that they incur to bring that inventory to a condition ready for sale, and they of course record the sales revenue during the period as transactions occur. So, how does a business using the periodic system record inventory purchases? Well, what they do is they record the inventory purchases and debit what's called a purchases account. So rather than debiting inventory, they debit purchases. So in this case, same example we looked at earlier, it's just that this business is now using the periodic system. We debit purchases for $20,000 and we credit accounts payable. So however they pay for it, whether it's with a liability or whether it's with cash. Okay, now on October 12, Devon is granted a $1,000 reduction in the cost of purchases due to blemishes of the inventory. So we record this as before, but instead of reducing the inventory balance, we record it to an account called purchase returns and allowances. And we credit that account because obviously this reduces the value of the overall purchases. So we obviously debit our accounts payable because we no longer owe this $1,000. And we credit purchase returns and allowances in this particular case. Now, Devon also pays $300 to transport the inventory to its place of sale. So, again, we don't use the inventory account when using the periodic system here. We instead use, in this case, when we're spending money, spending resources on transport in, we debit transport in. So rather than debiting inventory, we debit transport in here. Okay, what happens if they get a purchase discount? Well, again, we reduce the value of inventory. And in this particular case, this is done through crediting the purchase discount account. So we don't credit inventory here, we credit the purchase discount account. So if we line all that information up, what we have here is a summary of all the costs associated with inventory. And as you can see, this is exactly the same as we looked at earlier in today's workshop. However, notice when using this particular method, we debit purchases when acquiring, we debit transport in when paying for transport, and we credit purchase returns and allowances and purchase discounts when there's a reduction in the cost of our inventory. And so when using the periodic method, we have all these accounts to show where the increases and the decreases in the value of inventory came from. So it's quite informative in that aspect. So let's now look at determining the cost of goods sold when using this method. Right, so the same information as before, we want to determine what the cost of goods sold are at the time of sale. Now, so same information as before, but instead, remember in this particular case, what we want to do is we want to determine what the cost of goods sold is at the very end of the period. So when using the periodic system, all we have is a register and information on the acquisition of inventory throughout the period, as well as the associated costs to bring that inventory to a place of sale. So transport in and the reductions associated with purchase returns and allowances. Okay? So we don't know what our actual sales are in units until we do a stock take at the end of the period when using the periodic system, because that's when we determine our cost of goods sold. Okay, so these are the steps when using the periodic system. The first thing is to determine the cost of goods sold is you count the inventory on hand at the end of the period. You use an inventory costing method to assign a cost to the ending inventory, and then you calculate the cost of goods sold using the cost of goods sold model. Okay, so let's apply this. Specific identification is quite straightforward because remember, when using this method, we can specifically determine what inventory items we have sold. So here, when we do our stock take, we determine that we have 5 units that cost us $13 each, 20 units that cost us $14, and 35 units that cost us $15. So that's the total cost of that inventory. We deduct the value of that inventory from our cost of goods available for sale during the period. So this is where we simply add up all the purchases and deduct all the allowances, etc. That gives us $2,355. So if we work out based on our stock take that we have $870 left, we deduct that from what we had available for sale, which means we must have sold $1,485 worth of inventory during the period. So that's using the specific identification method, assuming you can specifically identify every individual inventory unit you have on hand. Now, what about if we cannot determine the exact units we have on hand based on when we acquired them and what exactly we paid for each one, because the barcodes are the same, but we purchased different batches of them and we paid different unit prices for those batches. Just like in the supermarket example I gave you earlier with the bottle of water and the bottle of Vegemite. So, if we apply the first in, first out method, first in, first out method means that the first inventory in is the first inventory sold. So in this particular case, when you're doing your stock take, what does that mean in terms of the inventory you have left? It means that if you sold the first lot in, you have the last lot left that you're counting up as part of your stock take. So remember, to determine the cost of goods sold here when using the periodic method, you look at all the inventory value you had on hand, which we know is $2,355. We deduct the value of the ending inventory, which gives us what we actually sold. So in this particular case, when looking at the first in, first out method, the inventory that we're going to be left with is the 60 newest inventory items that was in stock last, obviously, because they're the newest. So if we have 60 units left, we simply go back, and I'll get rid of this text so we can make this a bit clearer. Right, and we see that the last lot of inventory that we got in was 45 units at $15, and the second last lot was 15 units at $14. The total cost of that adds up to $885, so 45 units times 15. 15 units times 14 gives you $885. You deduct that from the cost of goods available for sale. That gives you the cost of goods sold for the period. Now, if you move on and we use the last in, first out method, assuming, of course, you're in a country or reporting for an entity that is based in a country that allows you to use the last in, first out method, which doesn't include Australia, then, of course, under the last in, first out method, the last inventory in is the first you sell, which means you're left with the first lot you got in stock, which is the 60 oldest units. Okay? So if I get rid of this text to see what's behind there, what we can see here is we have beginning inventory on hand, 40 units at $12. So we assume we have all of that on hand. And then we have 20 units at $13, which is the second lot we had on hand. So we multiply the units by the unit cost in each case, which means that we assume we have on hand $740 when we conduct our stock take. So $740 worth of inventory. We deduct that from the cost of goods available for sale, which gives you cost of goods sold of $1,615. Now, weighted average is the last method that we're looking at here. Again, what we need to do is we need to work out the value of ending inventory and deduct that from the cost of goods available for sale. So what you do when applying this method under the periodic inventory costing system is you add up the total cost of all inventory available for sale, which we know is $2,355. You divide that by the number of units you had available for sale, which is 175, which gives you an average cost per unit of $13.46. So you multiply the units you have left of 60 by that average figure, which gives you $807.60. Round that up to 808. And so you deduct that from what you had available for sale, which means your cost of goods sold is $1,547. So the key thing to remember here is when we're using the periodic inventory costing system, we determine the cost of goods sold at the very end of the period by calculating the value of our ending inventory through applying whichever assumption is applicable. And then we can determine what the cost of goods sold is by subtracting the value of that ending inventory from the cost of goods available for sale. As I mentioned before, most businesses don't use this because they have electronic systems where they constantly determine the cost of goods sold during the period, but some businesses do still use this system. So you need to be aware of it and how to account for it.